Good morning, everyone. Thank you so much for joining us today. My name is Hajra Talat, and I will be your host for today's webinar. So, the today's webinar's topic is effective record keeping for financial and tax compliance. Before we dive into the session, let me provide a brief introduction about our company, ACME Group. ACME Group has established itself as trusted tax and financial solutions provider across GCC region and Egypt. We are committed to delivering high quality solutions tailored to the needs of various businesses across different industries. Our focus on quality and expertise has allowed us to build long term relationships with our clients. Our exceptional team consistently delivers value efficiently, making us the preferred service provider in the region. Now, let me introduce our esteemed speaker for today's webinar, Mr. Taimur Khatak. Mr. Taimur is an experienced audit manager and tax consultant with over 6 years of experience in accounting, auditing, tax compliance, budgeting, and financial reporting. He holds a BSE in applied accounting and is a certified accounting technician and an ACCA member. Taimur excels in managing accounting operations, performing audits, and ensuring VAT compliance. His skills in evaluating internal controls and resolving tax queries make him a trusted advisor providing valuable recommendations to enhance clients' financial practices. So before we start, I would encourage everyone in the audience to share your questions in the Q&A section. I would emphasize on this point to share your questions in the Q&A section rather than putting your questions in the chat or raising your hands, because this way the speaker, Mr. Temur, would not be able to see the questions and would not be able to answer them appropriately. So your participation, since it's very essential for the success of this event, I would request again to put whatever questions you have in the Q&A section. I would now like to hand over the stage to Mr. Temur to commence the webinar. Over to you, Mr. Temur.
Uh, Hi everyone, and hi Adra. Thank you for using such kind words. For this webinar today, about effective record keeping for financial and tax compliance. For the table of contents, we have why accounting is required as per the IFRS standards. Then we'll discuss IFRS 15, revenue recognition, along with the industry-specific recognition criterias. We'll discuss a bit of IFRS 9 and IFRS 7 as well, and IAS 21, the effect of changes in foreign exchange rates. Then we'll discuss IAS 12, which is income taxes, and how to carry forward the tax losses. We'll also discuss the benefits of regular accounting health checkups and digital and physical record keeping and maintaining financial records. Mazin, can you please take us to the next slide? So as per the ministerial decision number 114 of 2023, uh, every taxable person needs to prepare a set of financial statements. It should not be limited to, but at least, this is what he needs to prepare. Statement of income, statement of other comprehensive income, uh, balance sheet, statement of changes in equity, and cash flow statement. So this is the minimum requirement that every taxable person needs to maintain and prepare for the tax year. Mazum, can you please take us to the next slide? And for the purposes of Clause 1 of Article 20 of the Corporate Tax Law, a taxable person has to apply international financial reporting standards without the prejudice to the provision of Clause 1. A taxable person for which the revenue does not exceed AED 50 million may apply for the International Financial Reporting Standards for small and medium-sized entities, which are known as IFRS for SMEs. And for the big group companies, um, they have to make sure that before the consolidation, each member of the group has their standalone financials ready. And on the basis of those standalone financials, a group consolidation needs to be prepared under the clause 1 of Article 42 of the Corporate Tax Law. Awesome. Can you please take us to next slide? A taxable person may prepare financial statement under the cash basis of accounting, uh, but there are two criterias which needs to be met before they choose the cash flow basis. The first criteria is where the person derives a revenue which is not exceeding AED 3 million. So it has to be below 3 million annually. Or the second criteria is in the exceptional circumstances and pursuant to an application submitted by the person to FTA, and on the of course on the basis of approval. Awesome. Next slide. So when we talk about why accounting is required as per IFRS, it has a whole lot set of benefits. It brings uniformity in the reporting, consistency. It makes it easy to do the reviewal. Um, it helps in accurate tax calculation because it promotes accuracy. It promotes more robust reporting. Uh, as well as the transparency. Also, it is like a legal and regulatory requirement, so it has to be done. It increases investors' confidence, not just the local investor, but the foreign investor also, because of the uniformity of the reporting structures. Along with it, it also reduces risk of the errors. Mazin, can you take us to the next slide? So this is the first poll question. How often should a business update its financial records to maintain compliance? Your time is 30 seconds and your time starts now. So the time is up. We've got 34 responses. 37% of the people think that the record needs to be updated monthly, and 34% people think that it has to be done on daily basis. Ideally, it needs to be as often as possible, but minimum is at least monthly. It has to be done. Awesome. Next slide. So here we go with IFRS 15 revenue recognition. It's a simple financial reporting standard with 5-step model. So the first step is identifying the contract. So there has to be a contract between two parties, which is followed by the second step, uh, which is identifying the separate performance obligation. Because in a contract, maybe there is more than one performance obligation. Later, we'll have example as well for further clarity. The third step is determining the transaction price. So there has to be a price attached to the contract. The fourth step is allocating the transaction price to the performance obligation. So if there is a price and there is more than one performance obligation in the contract, then we need to allocate the transaction price to each of the performance obligations. And the fifth one is uh, when the service has been performed, the revenue needs to be recognized. So it's a basic five-step model. Mosem, next slide. So when it comes to different industries, of course, there are different criterias for revenue recognition. First, we will start with the software industry. So recognizing revenue when it transfers control of a software license to a customer, which could be at point in time or over time. So for example, let's say if the software company provides the software a point in time and there's no further service attached to it, the revenue or will be recognized at point in time. But for example, let's say if the company is providing software and then also providing maintenance service for the year with the same contract. So that means the revenue will be recorded on a monthly basis as the service has been performed. So when it comes to telecommunication sector, the revenue recognition from service contracts evenly needs to be recorded evenly over the contract period if the customer benefits from the service over time. So that means it has to be recorded on a monthly basis. For construction industry, the revenue must be recorded on the basis of the percentage of the completion, or as costs are incurred over time of the contract. So as far as the for example, let's say if there's a building being constructed, once the 10% of the building has been constructed, you can recognize the 10% of the revenue. Once the 20% is constructed, you can recognize the 20% of the revenue. Or it also can be taken in a way, for example, let's say if the floor wise, for example, let's say if the first floor is constructed, you can recognize the certain revenue once the second floor is also constructed. So it's like floor wise or percentage wise, but on the basis of the completion. So for retail industry, recognize revenue at the point of sale when the customer takes control of the goods, either on delivery or picked up by customer. So when the goods are ordered, that means if once they get delivered and the customer collects the good, then a revenue can be recognized, or if it's a just in point sale, for example, let's say at at a POS machine in the shops. So once the customer takes the control and the transaction happens, they can recognize the revenue. For pharmaceuticals, recognizing revenue when they deliver products to distributors, provided that the customer has the control of the products. For healthcare industry, recognizing revenue when services are provided and the patient gets control of the service. So when it actually gets performed. For hospitality, recognizing revenue at time of providing service to the guests, such as when guests check in and start using the service. Mozam, next slide. So this is the first example, and it's a basic example. So for example, let's say if a software company has signed a contract with a client to provide a software license for 1 year for 12,000. That means there is a promise that the company will provide the customer with software license. So the contract is there, and also the obligation, which is providing the software, is also there. The third criteria was identifying the transaction price. So the transaction price was mentioned as 12,000. The fourth was allocating the transaction price to the performance obligation, as there is only one performance obligation, which is providing the software license. So all of the 12,000 will be allocated to that obligation. And fifth one was recognizing the revenue when the service is provided. So once the license has been provided to the client, uh, uh, then they can yeah. So revenue is recorded over the 1 year contract period as you provide a software update and support each month. So it's like a software and the updates also, so which will be provided over the 12-month period. So the revenue will be recognized evenly on a monthly basis. But if there was no update and supports involved, and then it would have been recognized on a point in time. Mosam, next slide. So which of the following is a key feature of an effective record keeping system? You've got 30 seconds and the time starts now. The time's up. 91% people have answered correctly. So the key feature of effective record keeping is having the real-time data access, um, real-time access to the correct data. This is the feature of the effective record keeping. Wasm, next slide. So this is the example with more than one performance obligation for your better understanding. So let's say if the company provides software solution along with support services that charges the software license for 1 year, 60,000, on-site training session for 20,000, and ongoing technical support for 1 year, 30,000 as standalone price. So the company is selling, if the company is selling standalone services, they're charging for the software licensing and support services 60,000, the training sessions 20,000, and ongoing technical support 30,000. But when it entered a contract with company B to provide the same services, uh, they had a total contract price which was 100 instead of 110,000. So that means now we cannot recognize the standalone prices. Now we need to allocate the total contract price to each of the obligations mentioned in the contract. Muslim, next slide. So when it comes to allocating the transaction price to each of the performance obligation, there were three obligations. First one was software license. The standalone price was 60,000, and the total of standalone prices for all of the obligations, it was 110,000. So it should be standalone prices for the software license divided by the standalone prices for all of the obligations mentioned in the contract, multiplied by the contract price, which was 100,000. So if you do the calculation, you will get 54,545. And now this 54,545 for software licensing, as the service will be provided and the ongoing support will be provided all around the year. So it needs to be recorded on a monthly basis. So that has to be divided by 12, which will give us 4,545 per month revenue that can be recognized. The second one was on-site training sessions. So it needs to be 20,000 divided by the total of the standalone prices for the obligations multiplied by the contract price, which was 100,000. We'll get 18,182. And this is the kind of service because it's provided only one time, not over the year. It's only a one-time training session. So this will be recognized once the training session has been conducted and the service has been provided. So it will be recognized just as a point in time. The third one is ongoing technical support. So it will be 30,000 divided by 110,000, which is the total of the standalone prices multiplied by the contract price of 100,000. We'll get 27,273. And also because it's ongoing technical support, which will be provided over the period of 12 months, so it will be divided by 12. This will give us 2,273 per month. Muslim, next slide. So now we'll be discussing IFRS 9 and how it specifies, and the specific how IFRS 9 specifies that entity should measure or classify the financial assets and financial liabilities in the financial statements. So there are two kind of financial instruments. One is financial assets and one is financial liabilities. When it comes to the classification and the measurement of financial asset, the initial recognition will be done on the amortized cost. The subsequent recognition will be done on either through the fair value through profit and loss or fair value through other comprehensive income. For financial liabilities, the initial recognition will be at amortized cost, but the subsequent will be at fair value through profit and loss. Awesome. Next slide. So if we are holding the financial asset in order to generate contractual cash flows, if this is the intention to hold the asset and for the generation of further cash flows, um, and receiving the cash flows by collecting contractual payments over the life of the instrument, it will be measured at amortized cost. And the basic examples are trade receivables, loan, bond held for maturity. If the financial asset has been held for to collect the contractual cash flows, as well as having an intention to sell the financial asset, it will be measured at fair value through other comprehensive income. And the example is equity and stock. Uh, and then there's a third business model, which basically refers to neither holding the asset with an intention to collect the cash flows, nor holding the asset to resell it. And in this situation, it will be measured at fair value through profit and loss. And the example is investment in equity and instrument. Muslim, next slide. So which type of record is essential for reconciling sales with VAT reporting? You've got 30 seconds and the time starts now. The time is up. 94% of the people have answered sales invoices, which is the correct answer. Muslim, can you please take us to the next slide? Uh, then, we'll move ahead to IFRS 7, financial instruments disclosures. So we'll start with fair value disclosures. Entities must provide disclosures about the fair value of the financial instrument, uh, either individually or in groups based on the nature of instrument, which will be followed by the disclosures. Standard requires entities to disclose information about the nature and the extent of risks arising from technical financial instruments, including credit risk, liquidity risks, and market risks. These disclosures should help user assess how the entity manages and mitigates these risks. The standard categorizes financial instruments into three main categories: financial assets and financial liabilities, and equity instruments. It also focuses on quantitative and qualitative disclosures. So IFRS 7 mandates both quantitative and qualitative disclosures. Quantitative information includes carrying amount, fair value, and the contractual maturities. Qualitative information includes description of the entity's and the risk management objectives and strategies, and information about credit risk, liquidity risk, and the market risk. Was the next slide. So now we'll be discussing IS 21, the effect of changes in foreign exchange rates. It is very important to recognize the exchange rate gains or losses for the correct reporting. So IS 21, the effects of changes in foreign exchange rates, prescribes how to include foreign currency transactions and the foreign operations in the financial statements of an entity, how to translate financial statements into the presentation currency. Inaccurate financial statements, this is the drawback of not following IS 21. It can lead up to inaccurate financial statements, which can result into the preparation of inaccurate financial statements, especially for companies and significant foreign currency transactions. This can lead to misrepresentation of the company's financial performance and obligation. It also leads to misleading financial ratios, as current ratio, quick ratios, equity ratios, or ROI, which is return on investment. It can be distorted if the foreign currency transactions are not accounted for correctly, and it will also mislead the investor, and ultimately, the foreign or the local investors' trust will be gone. It can also lead up to non-compliance penalties. Depending on the jurisdiction and regulatory authorities, there may be a legal or regulatory consequence for not following IS 21. Companies may face penalties, fines, or other enforcement actions if they do not adhere to accounting standards. IS 21 requires companies to recognize gains and losses from the foreign currency transactions in their income statement. Failure to follow the standard may lead to inaccurate, inconsistent recognition of these gains and losses, affecting the company's reported profitability. Mazum, next slide. So which of the following best supports the digital transformation of record keeping? We've got 30 seconds and the time starts now. The time's up. 97% people have answered correctly. Um, the best support that the digital transformation of the record keeping is, it has cloud storage and automation tools. Muslim, next slide. So for IS 12, which is income tax, International Accounting Standard 12 deals with the accounting for income taxes, current tax, as well as deferred tax. It provides guidance on the recognition, measurement, presentation, disclosure of the income taxes in the financial statement. In the context of United Arab Emirates, where the corporate tax rules apply, IS 12 is relevant for the financial reporting purposes. Here's how IS 12 applies to income taxes in the UAE. It can help in the recognition of current tax and the deferred tax. It also provides the guideline to deferred tax accounting, the measurement of deferred tax, the recognition of tax losses, the presentation in the financial statements, along with the disclosure requirements, changes in the tax rate, if there are any, and also uncertainty in income taxes. Muslim, next slide. So this is an example. As we have a capping of 12 million of allowable interest expenses as per the corporate tax rules, that will, lead to arise deferred tax assets, uh, or it will give place to deferred tax assets. The deferred tax assets represent the future tax benefits, which will help the company to expect to receive when it can be deducted the excess interest in the future years. So, for example, if the company is having an earning before interest and tax of 50 million drums, and that company is having interest expense of 15 million, so that means the accounting profit is 35 million for that particular company. But because there is a capping of 12 million, so not all 15 million is allowable deduction. So which gives us a difference of interest allowed as per CT expense of 3 million. So if we apply the 9% rate of on 3 million, it will give us 0.27 million of deferred tax, um, which can be recorded. And also we can see in this situation the accounting profit is uh, 35 million, but the taxable profit is 38 million by adding back the 3 million difference. Awesome. Next slide. Due to 75% of loss adjustments as per the CT will lead to uh, an increase in deferred tax assets. This deferred tax asset represents the future tax benefits the company expects to receive when it can offset its taxable income with the adjusted losses in the future years. As an example, if the company's earning before interest and tax is 50 million and the interest expenses are 10 million, that will give us an accounting profit of 40 million. But if there is a loss from the prior periods, which is coming from the earlier accounting periods of 15 million, so that means our we can adjust it, and which will give us a net book profit of 25 million. So adding the 25% of the loss, which was disallowed to be carried forward as per the CT law, as we can only adjust 75% of it. So uh, it will give us 3.75 million. Uh, so the net book profit was 25 million. By adding 3.75 million into it, we'll get taxable profit of 28.75 million, which will give rise to deferred tax asset of 0.34 million. Muslim, next slide. So as far as benefits of regular accounting health checkups are concerned, um, they're also known as financial and accounting review. It can play a crucial role in helping companies in United Arab Emirates to manage their corporate tax more effectively by identifying the errors and inaccuracies, ensuring compliance with the relevant laws. Uh, it does help in tax planning uh, and the projections related to tax planning, improving financial decision making, uh, risk assessment, precise tax reporting, and helping in building the trust between the investors and suppliers and customers. Awesome. Next slide. So businesses in UAE face several challenges when it comes to the implementing financial record keeping strategies uh, for compliance. Um, for that, there can be training and awareness. Many businesses may lack employees with sufficient knowledge and training uh, in financial record keeping for tax compliance. Training staff on tax regulations and accounting practices is crucial, but can be time consuming and costly. The second factor is data accuracy and integrity. Maintaining accurate financial records is essential for tax compliance. Errors in recording transactions, incomplete data, or inconsistencies can lead to penalties or audits by tax authorities. UAE tax authorities have strict deadlines for tax filing uh, and reporting. Businesses must ensure they have processes in place to prepare financial statements and reports in timely manner to meet these deadlines. Um, the fourth is integrated with other regulations. The financial record keeping um, for tax compliance often needs to integrate with other regulatory requirements, such as those related to company law and auditing standards. As far as changes in regulation is concerned, the tax laws and regulations in the UAE can change over time. Businesses need to stay updated with these changes and adapt their financial record keeping strategies accordingly. Accounting software implementation. Choosing and implementing the right accounting software can be challenging. For that, we need to keep in mind whether the software is also approved by FTA or not. Um, and also, does it provide the real-time access to the data? Uh, or maybe like it can get connected with live banking also. Um, it requires selecting software that meets the specific needs of the business, integrating it with systems, and ensuring that it complies with UAE tax requirements. Understanding the tax requirements also plays an important role. Many businesses struggle initially with understanding the tax laws and regulations in the UAE, especially if they are new to the tax compliance or if the regulations have recently been changed. So that also means it's a process of continuously updating yourself and keeping up with the changes that are announced. Awesome. Next slide. So this is the fifth poll question. What could be a consequence of poor financial record keeping? The time is 30 seconds and it starts now. So 97% people have answered correctly as the biggest consequence of having poor financial record keeping is getting tax penalties and fines. Was the next slide. With that, we'll be talking about digital and physical records, how to maintain proper record and how to maintain proper financial records. Digitalizing in financial record keeping. Digital records offer several advantages, such as accessibility from anywhere, security, and efficiency. They allow businesses to retrieve the data quickly and ensure compliance with the UAE regulatory standards set by the entities like Federal Tax Authority. Best practices for implementing digital record keeping system includes using secure cloud-based platforms and regularly backing up data to prevent loss. Regularly keeping the backup of data is very important, just in case if anything happens, at least the data will not be lost. Managing physical records. While digital records are essential, maintaining physical records is equally important. It ensures compliance with the retention policies and legal requirements in the UAE. Strategies for organizing physical records include proper labeling, categorization, and secure storage facilities. This guarantees accessibility and protection against physical damage or loss. Nazim, next slide. Thank you, guys. This is it from my side. Handing over to you, Hajra.
Thank you so much, Mr. Temur. It was truly informative, the session you just delivered. Thank you so much for having this insightful and engaging session. We'll move on to Q&A segment now. But before we proceed, I would like to let everybody know that webinar feedback section is now live. Please give us the rating, our speaker, the rating, Mr. Temur. And additionally, please scan the QR code displayed on your screen and give us your feedback on our website, on the Google reviews as well. It will be very important for us as it helps us to improve our sessions in the future. So now moving on, I would like to invite Ms. Bima Ashraf and Mr. Temur Khatak to answer the questions from our wonderful audience. Over to you, Ms. Bima and Mr. Temur.
Thank you, Hajra. Thank you, Taimu, for your insightful session. So we'll move to the first question. The question is from Ms. Fatima Al Suwaidi. What are the essential financial records that business need to maintain for tax purposes?
Okay. So for the minimum one is maintaining statement of income, statement of other comprehensive income, statement of financial position, which we call as balance sheet, statement of cash flows, and statement of changes in equity. This is the minimum that they can maintain.
Okay, thank you, Taimur. So the next question is from Mr. James. In general, how long should the companies keep their financial records on file? Are there any exceptions?
Okay. The minimum requirement is 5 years, but ideally and practically it should be minimum 7 years. Like at least they should keep it for 7 years. But as per the law, it is 5 years.
Okay. So the next question from Ms. Aisha Khan. What could go wrong if a business doesn't keep accurate or complete records?
So if a business is not keeping accurate or complete records, there are so many things that can go wrong. It can lead up to wrong VAT filing. It can lead up to wrong corporate tax liability being calculated. It can also have one of the consequences is maybe the company will be penalized or fined by the regulatory authorities for not doing so, because all of the companies are legally obliged to maintain their records.
Okay, so the next question is from Muhammad. What practical steps can a company take to stay compliant with the financial record keeping requirements?
What steps a company can take to keep up with the financial record keeping requirements, right? So,
Yeah.
first of all, they can make sure that they have a robust team. Their team is well trained. Their team is aware of the changes in the laws. And if the team has the basic sense of accounting and they're keeping themselves up to date, there will be no trouble. For that, they can conduct weekly or monthly training sessions inside the company. So if there is any lack or if there is any gap, it can be addressed timely basis on a timely basis.
Okay. So the next question from Ms. Linda. As many business move to digital systems, what are the some practices for keeping the digital records?
So as most of the businesses are moving to digital record keeping, as it is easy to locate the data, um, and it doesn't take much place. So So that is the good part, but the companies need to make sure that they have the backup of the data for all of the files, and they also need to make sure that that the cloud system that they are using is has a well uh, firewall in place for the data protection, and make sure that if the data is in available in the cloud system, there is a restriction or uh, approval requirement. So for example, let's say only certain file needs to be reviewed by certain people or authorized people. It's not like any file can be reviewed by anyone, so there has to be some passwords on the file, or maybe the access needs to be limited.
Okay. So the next question is from Mr. Vijay Kumar. Under IFRS, consolidation of the books is done including overseas subsidiaries, which are not tax group members, but FTA requires to submit audited FS exclusively for tax group members. How to handle it? I think this question is more related to the CT, but maybe you can help
Yeah.
too.
Yeah. So first of all, they need to make sure any company which is in the group, or it's in in the, under the consolidation, they need to make sure that they have their standalone financials ready. So it's not like the consolidation needs to be done first. First of all, the standalone financial audit needs to be done first. When all of the entities have their standalone financials done, then we can do the aggregation, and we can combine the into one consolidated accounts by removing the intra-company transactions.
Okay. And the next question is from Manish Singh. What will be the tax impact of goods, all the receivables write-off and all the payable write-back, which relates to the tax period before corporate tax implementation?
So before corporate tax implementation, that means he's talking about before June 2023. That mean if there's any receivable which they think is a bad debt and will not be received, or if there is a payable associated with it which will not be paid, they can be adjusted by passing the correct entries, and of course by maintaining the relevant documentation. So for example, let's say if it's a bad debt, a board resolution needs to be prepared first before writing it off, which needs to be signed and stamped by the authorized signatory. So as long as the correct documentation has been maintained, yes, they can perform the write-off of the receipt, but there has to be some basis attached to it.
I think that answers to the questions to Mr. Manish. So the last question due to the time constraints uh, from Mr. Kimberly. When is the implementation of e-invoicing for companies at UAE? Is this mandatory?
Yeah, it will be mandatory. It will be starting from next year. Uh, uh, so that's like whole another topic of e-invoicing. Yeah, but it will be implemented next year. That's your question.
Yeah. Okay, thank you, Mr. Taimur.
Thank you.
We are having more questions, but due to time constraints, we are not able to answer everything. So if you like, if anyone else have any other questions, you can drop an email to the email that we are showing. So off to you, Hajra. Thank you.
Thank you so much, Bima. Thank you so much, Mr. Temur. Thank you so much, everyone in the audience, for joining us today. Your presence and participation has made this session a valuable and impactful session for us. And we look forward to connecting with you again in the future. And until then, if you have any further queries regarding excise, VAT, or corporate tax, please feel free to reach out to us. The details are mentioned on the screen, and you can send us an email, drop us a call, and our team will try to help you out as much as possible. Until next time, thank you so much and have a great day ahead. Bye.